A stock of the day is Metcash, net profit down despite growth across its food, hardware and liquor businesses, with group revenue increasing close to 8% to just shy of $9 billion. Brands for a number of its businesses, including IGA, Mathan and Celebrations, all up. The increase in revenue offset by increases in fuel, freight and labour costs. So, Gaurav, Metcash, and we're talking about, we've still got to buy, our staples, haven't we? So a business like this survives in this sort of environment.
Generally, inflation can be good for these fast turnover businesses that have really attractive working capital dynamics. By that I mean that these supermarkets generally get paid faster than they have to make payments themselves, so they're insulated in a way from high inflation. And more than that, they take a percentage cut. Their margins are a percentage of the sale price. So in a high inflation environment, the margins can actually expand historically in these businesses. So it's not necessarily a terrible place to be, but I think the market's well aware of that. And supermarkets across the board have been unrealistically priced, in my view. I would say the same for Metcash. I'd say Metcash probably has surprised a bit. The performance has been very good. It's always had fantastic management. I think there was an idea that they'd get squeezed between the two big guys. They've actually carved out, which I think is a sustainable niche for themselves, and they're performing really well. There's a bit of cost pressure in there, but I expect that to be passed through or to be controlled by management over time, and so that doesn't concern me too much. It's very encouraging to see that they appear to be doing well in all their business segments and doing something differentiated from the big guys, which is always the key for a third-party player like this. I'm happy to hold Metcash. It's a business in a weak competitive position with a very strong management team. The finances look okay. I think you can eke out okay returns from here. It pays decent dividends. It's not a disaster, but really, there are some really interesting areas in the market right now, and I would be more inclined to think of this as a funding source. For me, I'd rather hold this, to be honest, than Woolies and Coles. I think Woolies and Coles are crazily priced. I'd be selling both of them. Right. That's where everyone's gone to hide. That's where cautious money is sitting. And in downturns, it pays to be bold. You don't want to be taking risk when everyone else is taking risk, but when everyone is cautious and running away from risk, that's probably the time to lean into risk a little bit. So I'd be selling Woolies and Coles. This one's still, I think there's still a bit of valuation support. I'll go hold.
Okay, Mathan.
Ooh,
I didn't think you'd like that, Mathan.
Yeah, look, we've been fans of the staple sector. If you look at what happens on a sector thematic, whenever you have a down day, you'll find staples is one of the sectors that outperforms. So in that scenario, as part of your portfolio risk management, I think staples plays a part in it. I think Woolies has underperformed compared to Metcash. Metcash has outperformed. I have to say Metcash is slightly different to how the others are. Yep. So you've got your Aldi that is nipping at the heels of a few of them. Aldi's done quite well. I think Coles, Woolies is a better business and probably have less capex issues than Coles. So we prefer that on that cycle, and Woolies is the biggest player.
Mate, so that's like 25 times earnings. Google is now a 15 times earnings. It's very hard to buy Woolies when Google is sitting there at sort of 15 times earnings.
Yeah, but the cyclical nature of Google is now the market is, I suppose, appreciating it, where the defensive nature of Woolies, the market hasn't appreciated as much.
I reckon Google has more cash than Woolies' entire market cap.
Yeah, but
and then some.
The problem for most of those techs is the fact that it's such a crowded trade. Everyone is there over the last couple of years. So the problem for them is getting the new guy to come in and put the money, and that's where it struggles. Look, in a global sense, yes, I understand where that's coming from, and higher rates is probably going to hurt them. But Woolies is one of those ones where I think they can play a lot more defensive. They can pass on the cost. The biggest problem a lot of these guys are going to have in the short term is the energy cost. It's going to hit them hard because it's not like you can turn off the lights or turn off the air conditioning. You've got a massive site and you're going to be keeping all of this.
Transport.
Exactly that, wages, all of these are going to hit them. And I don't think people are understanding how, and the other part of it is the consumers. Again, as we were talking before, consumers are just adding more and more debt. And at some point that stops. And we've been amazed at the level that they have got to, and this is a global problem. It's not just in Australia. Globally that's happening, right? And so at some point the consumers will start to pull back. I think the staples holds up better than retail, but I think still struggles. Metcash for me, it's a hold. I think it's been run well. I think it plays to the thematic, so it'll hold. I don't think you're going to get much of a return, but if you've been there, you've had the appreciation, you're still picking up a good yield. I don't think anything's going wrong yet, so I'll be hold on the whole sector, and Metcash is one of them. So I don't think any of them are suddenly in trouble, but I don't think you're going to get the bigger return. I think that net within that sector, I think Woolies is giving you a better discount than Metcash.
But so you got to hold on Woolies and Coles as well.
We are actually on a hold on Woolies. We're not fan of Coles on a relative basis. I think Metcash is on a better earning cycle than Coles. So if you had to pick an order for me, I'd be Woolies, Metcash, then Coles in that cycle.